Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Wish's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Context Logic is better known as Wish. It is an online e-commerce platform that facilitates transactions between buyers and sellers. The platform has browsing technologies which personalize shopping visually for each customer, rather than relying on a search bar format. Sellers are able to list their products on Wish and sell directly to consumers. The company's software works with payment service providers to handle payments, and the company does not stock the products themselves or manage returns. And as I mentioned earlier, they sell directly to consumers. This eliminates distribution fees, so the customer gets a low-priced product. The bulk of the merchandise comes from China and other overseas companies. Most of the products are small, so it's cheaper to ship. The company has an agreement between China Post and the US Postal Service that lowers cost of shipping for goods that weigh less than 2 kilos. Wish has a Wheel of Fortune style game called Blitz Buy. This integrates a layer of gaming to offer consumers additional discounts on top selling items. The company is headquartered in San Francisco, California, and was founded in 2010. It trades on the Nasdaq, Deutsche Börse, and Mexican Bolsa. Let's get started with the model. This is a small cap company, 1.6 billion market cap. They're trading at $2.45 a share, and they have 643 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They have negative free cash flow every single year. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also negative each year. Revenue is the sales for the company, and that went from 1.7 billion to 2.6 billion. So it is increasing, but not that fast of a rate. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. The cost to maintain the website is part of cost of revenue. Revenue minus cost of revenue gives you your gross profit, and that's been pretty steady. It was the highest in 2020 at 1.6 billion, but the trailing 12-month number is almost identical to 2018. Below that is their operating expenses. Marketing is a big operating expense for this company. Gross profit minus operating expense gives you your operating income, and that's negative each year, and the negative is getting bigger. They have hardly any debt, so they received more interest on their investments than they paid on their debt. Their interest income minus their interest expense is $9 million in the trailing 12 months. Then below that is other income and expenses. These are all the gains or losses not part of the company's core operations. They had a big expense in 2020. This is probably an asset impairment. Below that is their pre-tax income, then their taxes, and the bottom line of the income statement is their net income, which is negative and getting worse each year. This is their income statement from their quarterly report. The first 9 months of 2020, the first 9 months of 2021, the third quarter of 2020, and the third quarter of 2021. So their revenue has gone down. It was 606 million in the third quarter of 2020. Now it's 368 million. Their revenue for the first 9 months of 2021 is pretty much equal to the first 9 months of 2020. In the third quarter of 2021, they received 183 million of revenue from their core marketplace. These are the commissions the company charges for each sale. They separate out product boost revenue. Sometimes they highlight certain items on the website, and the fees they collect from those items go into product boost revenue. And they generated 148 million of revenue from shipping out products. So all of their revenue went down. Logistics is pretty similar to last year, but their core marketplace revenue went down pretty dramatically. Below revenue is the cost of revenue. So it cost them $201 million to generate the 368 million. And their gross profit is 167 million. Their gross margins are 45%, which is a lot higher than the average in the industry of 32%. The median is 30%. So they are doing well in that category. Sales and marketing is down a lot from 386 million to 147 million. Maybe that's why revenue is down so much, because they're doing less marketing. Product development is up from 24 million to 54 million. General and administrative is 29 million. They had an operating loss of 63 million, which is better than last year of 78 million. They've issued a lot of common stock. They were 108 million in the third quarter of 2020. In the third quarter of 2021, they're 628 million. That's almost 6 times as much. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. So you could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So they did break even in 2020. That was their best year. They lost over 900 million in the trailing 12 months. The first time I saw this, I thought it was a mistake in Yahoo Finance, because sometimes they don't pick up numbers. This is from the company's annual report. They had a net loss of 745 million, and all these adjustments equal 745 million. So they have 0 of operating cash flow. And they spent 2 million in CapEx. So their free cash flow for 2020 is negative 2 million. Technology companies tend to not spend much in CapEx. They only spend a few $1,000,000 a year. Operating cash flow minus CapEx give you your free cash flow. And they do have negative free cash flow every year. So they're mainly running their business on stock. They issued 160 million in 2019 and 1 billion in 2020. Every time the company issues common stock, it increases the shares outstanding and makes your shares less valuable. Here's the operating cash flow section from their latest quarterly report, the first 9 months of 2020, the first 9 months of 2021. And the way you calculate operating cash flow, you start with your net income or net loss. Then you have to add or subtract the non-cash items on the income statement, then adjust for changes in working capital. So we start with the net loss of 303 million. We add back the non-cash items, 100 million of stock-based compensation. We adjust for changes in working capital. Even though they reported an accounting loss of 300 million, they actually lost 900 million of cash flow. Last year, they had an operating gain of 24 million. This is the investing and financing sections. They purchased 235 million of marketable securities. These are short-term investments like commercial paper, so they can earn a little interest on their cash. And 200 million of marketable securities matured, and they sold 50 million. So in their investing section, they had a cash inflow of 16 million. Not much going on in their financing section. This is the equity section on their 9/30 balance sheet. They have 800 million of equity. They raised $3.3 billion from selling their business, and they lost $2.5 billion from running their business. Let's look at the capital structure. 829 million of equity, 18 million of debt. They're 98% equity, 2% debt. And they could pay off all the debt with the cash on their balance sheet and still have 1.2 billion of cash left over. And I gave them the highest WACC of 10.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. That's 5.3 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $3 billion. We divide that by 643 million shares. And we get a calculated stock price of $4.59. They're trading at $2.45, so they're trading at a 47% discount. It's a buy according to the model. Their revenue is projected to increase 13.7%. So I grew their revenue 13.7% for the next 4 years. That's how I got their future revenue estimates. The average company in their industry converts 11% of their revenue into free cash flow. So I multiplied their 2024 revenue by 11%. That's how I got their future free cash flows. And I assumed they would have negative free cash flow in 22 and 23. So unless you think this company is going bankrupt, there's probably a good amount of upside. But I would say it's 50-50 on going bankrupt. It doesn't look so great for this company. Since they're an active company and they're not behind on their debt payments, I can't value the stock at 0. It has to be something. It's like your chance of winning the lottery. It's not 0. It may be close to 0, but it's not 0. Simply Wall Street is way higher than me. They're at $17.46 a share. They're saying it's 86% undervalued. 5 analysts priced this stock, and the average price target is $4.70. The low is 3, the high is 6. This is where the stock has been trading since it IPO'd. The first time you could buy the stock was at the end of 2020. and right away the stock went up to over $30 a share. And that's pretty common. The stock price generally goes up initially because there's lots of excitement and many people are buying the stock, and then there's a big sell-off. But unfortunately, the sell-off continued and the stock is trading at its all-time low. Plus, the company also did a lot of stock dilution, which also brought the price lower. The stock is down a whopping 90% in the past 52 weeks, while the S&P is up 19%. The 52-week low is 243, the high is 33. And the stock is trading below its 50-day and 200-day moving average. Over 20 million shares are traded each day on this stock. Of the 643 million shares outstanding, 440 million are on float. Half the shares are held by institutions, and it has a really high short percentage. 24% of the shares on float are shorted. So the bears are making a killing because the stock price has been coming down a lot. Their employee count has gone up a little bit the past year. They currently have 875 people on staff. If you invested $10,000 into this company when it started trading, you'd be really unhappy, down to $1,200 today. That's an 88% loss. In the past year, no insiders have been buying the stock, only selling, lots of selling. Here's a list of all the insiders that have sold in the past year, the date, the name of the person, the shares, and the stock price. So it seems like everybody and their mother has been selling this stock. Not a good sign. The public owns half the company, institutions 22%, venture capital and private equity 13%, insiders 10%, and private companies 4%. The CEO of the company owns 9% of the stock, 56 million shares valued at $138 million. The next biggest shareholder is Formation 8 Partners, Vanguard, GGV Capital, and Republic Technologies. Let's look at their financial ratios. We can't look at the PE since they have negative net income. They have a really good price to sales of 0.6, that's stock price over sales per share. So investors are paying 60 cents for $1 revenue. That's much better than the market median and average. They also have a really good price to book at 1.9, that's stock price over book value per share. Here's a list of their non-current assets: 17 million of property and equipment, 20 million right of use assets. These are assets the company leases or finances that another company owns. 7 million are marketable securities and 6 million of other. They have a good current ratio and quick ratio of 2.5. Let's look at their current assets: 1.1 billion of cash, 143 million of marketable securities, 27 million of receivables, and 73 million of prepaid expenses. Let's look at their current liabilities: 70 million of accounts payable. This is how much money Wish owes other companies. 216 million of merchants payable. This is how much money Wish owes its merchants. This is more of a timing thing. 23 million of refunds and 209 million of accrued liabilities. Accrued liabilities are expenses the company incurs but hasn't paid yet. In the trailing 12 months, they had negative 928 million of free cash flow, and they currently have 800 million of working capital. Working capital is current assets minus current liabilities. So it looks like they're going to be short $131 million. So they may need to add some debt or equity financing to get through the next 12 months. The best way to look at ratios is to compare them to companies in the same industry. There are 48 companies in the same industry as Wish, and Wish has a better debt to equity ratio than the average company. They pretty much have no debt. They have a really good price to book because they raise so much cash from all the capital raises, and they have a really good price to sales ratio, much better than average. And of the 48 companies, they rank 22nd in terms of market cap. Their market cap is 1.6 billion. The average is 52 billion. So they're competing with some really big companies like Amazon. So to summarize, I have them trading at a 47% discount. I'm not sure about a long-term hold for this stock. I think it could be a good swing trade, but I think it's a little risky at this point. It doesn't seem like the company has established itself yet. And their sales are pretty much static. They're not really growing, especially year over year. That's a little concerning for such a young company. I rank their free cash flow as 1 out of 10, their revenue 6 out of 10, and their ratio is 4 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.